So let's get started. Now, the good news is we've noticed inflation has been falling over the last month. This basically means that the RBI will probably bring interest rates down even further in its next review. That means on one hand that your home loan will become more affordable and your EMIs will stop cutting such a massive hole in your pocket. On the other hand, it also gives you a very nice opportunity to profit from those falling interest rates and make some extra money. Take a look at how you can do that.
Investing all your money in a single asset class is like putting all your eggs in one basket. What happens if that one basket becomes shaky? The right idea is to diversify. When you invest in two different asset classes, like debt and equity, that tend to move in opposite directions, in different market conditions, the combination will have a stabilizing effect on your portfolio. When investing in a debt instrument, three things should be kept in mind: flexibility, capital protection, and taxation. While traditional investment options like fixed deposits and bonds protect your capital, they do not offer you flexibility. Debt mutual funds, on the other hand, have no lock-in and give better returns than a fixed deposit and are more tax efficient.
If you put your money in an FD, then the interest income is actually clubbed with your other income and it's taxed as per your income slab. But if you're a debt mutual fund investor, if you take an investment, if you put in an investment option with a time horizon of more than a year, you can go in for a growth option, and there you have the capital gains tax. So that is taxed at 10% without indexation or 20% with indexation.
The other big advantage that debt funds offer is the ability to profit from the interest rate cycle. Interest rates and bond prices are inversely related. Simply put, when interest rates begin to fall, the prices of previously issued bonds start increasing.
Actively managed debt mutual fund will basically earn from two sources. One is the accrual, the second one is capital gain. Typically, when the interest rates are falling down, which is the current scenario, a lot of actively managed funds, they raise the duration and they make capital gains out of it, which ultimately leads to a healthy return for the end investor. If you look at the last 1 month return for most of the actively managed bond funds, they're typically in the vicinity of 35 to 40% annualized returns. So I think in a falling interest rate scenario, the capacity of an actively managed fund to raise duration and capture the interest rate movement is far better than any other instrument, and hence a debt mutual fund will benefit the investors in a falling interest rate scenario.
So depending on your time horizon, you have the following debt mutual funds to choose from: the ultra short-term liquid funds, short-term funds, income funds, glit funds, and dynamic funds.
At this point of time, our opinion is that it's better to get into an actively managed dynamic bond fund, primarily because the rates have come off quite a bit and it's been a secular rally, to say so. So if you talk about, almost 40 days back, the 10-year GSEC bond was roughly at around 8%, and now it's come off with the new 10-year benchmark being at 7-10 levels. So I think there's a considerable amount of rally which has already happened, and while the overall view remains that the interest rates will go down, but it will not be a one-sided rally and there will be intermittent volatility. I think a dynamic bond fund is an ideal fund to capture those kind of intermittent volatility and benefit the investor if the fund manager takes the right calls.
Falling interest rates can be an opportunity for you to get double benefits. The benefit of lower interest rates on your home loans, car loans, and other of good returns on your investment in a debt mutual fund.
All right, we hope you got that down. Let me bring in Dhirendra Kumar now, the CEO of Value Research and our in-house mutual fund expert.